Hello, this is John Piper with the weekend video clip a day early. It's 13th of March. I'm doing it today because I've got quite a lot to say about markets and I'm having trouble actually fitting the report in tomorrow. Right, we're going to start with the Dow. This is the market that, as you know, turned back from Bill's resistance area. I sent the chart out recently, last weekend I think. Because we've now yet again taken out the wave one, this rally has taken out the wave one low. That's something that shouldn't happen, Elliott. It looks to me it's now definitely a corrective formation, A, B, C, then a nice clear B wave to there, and then A, B, C. I guess there is one slight alternative count there we could look at. You could say it's a 1, 2, 1, 2, and then a 1, 2, 3, 4, and then a 5. Very subnormal 1 and 2 wave, not impossible. This will make this a 4 wave, which it can do because of course wave 1's now up here. So I guess the bear case has some kind of hope, but I wouldn't say it's too much to bank your hopes on, especially when you look at other markets actually. And the Dow, I'd say that's corrective. This looks like new impulsive action, so a bit of a correction might be a buying opportunity. But if we look at FTSE next, well, we've discussed a very strong minus development above 6,950. We've made all new all-time highs, but each one has been a failure. So we've now had 4, 5, 6 failures at, so is that 5 or 6? Maybe it's 5. 5, above 6,950. We've got an ABC here, which is a corrective phase, followed by a B wave, then a 1, 2, 3, 4, 5. So if this is impulsive, it would encourage a view that we're now going to go up. So let's have a look at that pattern in shorter term chart. Okay, this is a 5-minute chart. Well, a fairly clear 5 waves here. 1, 2, nice thrust on the third wave. 4 and 5. Then we've got an A, B, C to there. But we're now retesting that. So slightly ambiguous. We need to see what's going on around 6, 750. If we see a decent spike here, then I'll be looking to buy FTSE at that point with a stop below the spike, obviously, and it would look a fairly clear case for a move into new highs. However, given that very strong resistance around 6,950, well, one need to be fairly cautious at that point. Right, the DAX. Well, I went short of the DAX yesterday. The reason being that we had a very clear pattern: 1, 2, 3, 4, 5, which was a third wave with a 1, 2 here, 1, 2. And then 4, 5 here. So a very clear 5-wave pattern into that peak. And you then look at this chart, sorry, this decline in the shorter term, you'll see that we had 1, 2, 3, 4, 5. It's also quite nice that we broke below the big round number 11,800, which is there. So that added some credence to a stop, which is above there, which is where I placed my stop. We then had a clear A, B, C. Having seen that, I sold this decline, alerted subscribers. We then saw a break below the extreme stop I placed there. That then failed. With extreme stop rules, one of the options is to see what goes on. If you see a failure, just get out quickly, which is what I did. We then had a rally here and another peak. So that was we then at that point had a double top. So the position looked more solid yet again. In the event, we just went sideways. Got stopped out IG later on in the day. Now, one key point with any trade is that not every trade wins, obviously. We all know that. Because of that, we use money management. That means we don't risk more than 2 to 4% for any one trade. 2% is better when starting out, though often you need to trade a bit more than 2% because the mechanics just don't work. But certainly what you have to do is know what you have to plan your trade. So because a percentage of trades always go wrong, you must know where your stop is, you must know what your risk is, and that risk must be acceptable. If it's not acceptable, then you shouldn't take the trade. That's all there is to it.